Testing. Hello. Testing. Okay. Oh, here we go. Share screen. All right. This is day 9 session 9 of studying for the FAR section of the CPA exam using the tool I've created called CPAcioli. Here it is. The mission statement is CPA Exam Prep you can actually afford. So it's starting at $19 a month. You can do a 7-day free trial, no credit card required if you want to test it out. But this is me just going through and live streaming my progress. Like I said, using my own app that I've created. And I think it's one of the best out there. And it's obviously the cheapest out there too. So click the link in the description if you want to try it out. So we click sign in here. And loading screen, taken to this. These are the stats that you can see here. We're going to go practice, multiple choice questions, unanswered, all confidence levels, all difficulty levels, and all sub areas. Here are the sub areas. And let's begin. So we'll do around 30 of these. I'll try to get around an hour, not too long, not too short for y'all, just little sessions. So, yeah, feel free to follow along. Let me know in the comments if you have any questions, and let's get into it. So which inventory costing method is the most appropriate for a business that sells a relatively small number? Yeah, for a relatively small number of high value would be specific ID method because each unit's actual cost can be individually tracked and matched to its sell. Awesome. Only government-wide statement of net position. A government's net position is played in 3 components. Which of the following is one of those 3 components? So net position, I believe, is the government's version of a balance sheet. So I believe it would be B. Shoot. Okay, net investment in capital assets. All right, let's see. The government-wide statement of net position displays net position in 3 components: net investment in capital assets, restricted and unrestricted. Okay, I think I mixed up governmental fund from government-wide statement of net position. So net investment in capital assets is one of the 3 required components of net position on the government-wide statement of net position. Okay. Net investment in capital assets. All right. Good to know. Quill Software Inc. enters into a contract to sell a perpetual software license bundle with 1 year unspecified when and if available updates and technical support for a total price of $120. Using the relative standalone selling price method, how much revenue should Quill allocate to the software license? So I believe it would be 100 divided by 100 plus 25, which is 100 divided by 125, which I believe will be 20. Let's see. Yeah, so 20%, 80%. And then 80% times the 120. And 96,000. All right, so yeah, I added I divided that by the total of those two, since those are the two prices, and then multiplied by the total price. When the contract price differs from the sum of standalone selling prices, the discount is allocated proportionally to all performance obligation using relative SSPs. Cool. Company grants employees stock options with a grant date fair value of $8 per option. The company grants 20,000 options, which vest over a 4-year service period and expects all options to vest. What amount of compensation expense should the company recognize for year one? Assuming it would just be 660,000 divided by 4. Cool. Total grant date fair value of an equity classified stock option award is recognized as compensation expense on a straight line basis over the requisite service vesting period. Cool. It's spread evenly over the 4-year requisite service period. When should a company accrue a loss contingency as a liability in its financial statements? I believe it's C. When it is probable that a liability has been incurred and the amount of the loss can be reasonably estimated. Requires both a probable and reasonably estimable criteria to be met before a loss contingency is accrued as a liability. This choice states both conditions correctly. Cool. Under U.S. GAAP, is a company permitted to report cash flow per share as a supplemental measure in or alongside the statement of cash flows? I really don't know. I mean, that made the most sense, but I'm not sure. Okay. ASC 230 prohibits reporting cash flow per share to avoid implying it is an alternative to earnings per share. Specifically prohibits the reporting of cash flow per share in financial statements prepared to prevent users from mistakenly viewing it as an alternative or superior measure to earnings per share. Cool. Good to know. Company sells a product with a standard 1-year assurance type warranty that promises the product will function as specified, providing no service beyond fixing defects that exist at the time of sale. How should the company account for this assurance type warranty? Assuming A. Yes, account for it under ASC 460 as an accrued warranty obligation, not as a separate performance obligation under ASC 606. An assurance type warranty, which simply provides the customer assurance that the product complies with agreed upon specifications is not a separate performance obligation and is instead accounted for as a contingent liability. So it's not separate. And a business combination acquired identifies a customer relationship, intangible asset with an actual acquisition date, fair value of $60K, estimated useful life of 6 years, straight line basis. Oh, okay, that's easy. Should be. Yeah, just 60,000 divided by the 6 years estimated useful life. Identifiable intangible assets recognized in a business combination with finite useful lives are amortized over those useful lives, typically on a straight line basis. Unlike goodwill, which is not amortized and is instead tested for impairment, finite-lived identifiable intangible assets recognized in business combination are amortized over their useful lives. Awesome. Company decides to abandon a piece of equipment before the end of its useful life, planning to use it until the abandonment date rather than actively marketing it for sale. How should this asset be accounted for prior to abandonment? Maybe D. I'm not sure that. Let's see. Well, let's see. Maybe C. Nice. Continue to classify it as held and used, depreciating it until the abandonment date. A long-lived asset to be disposed of other than by sale, example, abandonment, does not meet the held for sale criteria and continues to be classified as held and used until the actual disposal date, with depreciation continuing rather than ceasing. An asset to be disposed of other than by sale, such as abandonment, does not meet the held for sale criteria and remains classified as held and used, with depreciation continuing potentially over a revised remaining useful life. Nice. I think we only missed the first one so far. It's pretty good. Which of the following cash transactions should be classified as operating activities on the statement of cash flows? Cash paid for the purchase of equipment, that's investing. Well, it's to be used in operations. I think it's still investing. Cash paid, maybe. Cash paid to retire long-term debt should be financing. Cash paid to repurchase the company's own common stock on the market should be financing. Cash received as dividends on equity securities held for investment should be cash received as dividends should be operating. Awesome. So yeah, purchase of equipment is investing, and then repurchase of own common stock and retirement of long-term debt is financing. Dividends received on investment is operating. Dividends received on equity securities are classified as operating. They represent a return on investment earned in the normal course of business. Company issues $1 million bond, $1 million of bonds and incurs $30,000 of bond issuance costs. Bond issuance costs. I'm trying to think of bond issuance cost would be capitalized or expensed. Legal fees. I think it's expensed. All right, let's see. Reported as a direct reduction of the bonds payable, like a discount, amortized to interest expense over the bond term. Under current GAAP, debt issuance costs are presented as a direct deduction from the carrying amount of the related debt liability, consistent with the presentation of a debt discount, and are amortized to interest expense over the term of the debt. And are amortized to interest expense over the term of the debt. Current GAAP requires bond issuance costs to be presented as a direct reduction of the bond's payable carrying amount, similar to a discount, and amortized to interest expense over the bond term. Okay. And amortized interest expense for the bond term. Good to know. Our reporting unit has a total carrying amount of 900, which includes 150 of goodwill. Okay, so it would be 900, which is the carrying amount, minus the fair value of the reporting unit is 820. Since the carrying amount is greater than the fair value, then it is impaired, and it would be a difference. So it's 800 or 80,000 impairment. And then because that 80,000 is less than the goodwill, then they can recognize the full amount. Impairment loss equals the excess of the reporting unit's carrying amount over its fair value, limited to the total amount of goodwill located at that reporting unit. So the full ADK excess is recognized as the impairment loss under the simplified one-step test. The company holds a portfolio of trading securities. So trading is recognized immediately. So it should be, I think, just 20. Because they had 300. They purchased additional 50. Should just be 20. Yeah. The unrealized holding gain on trading securities equals the change in fair value of the total portfolio during the period measured against the total cost basis, since no sales occurred. Comparing the 370,000 ending fair value to the 350 total cost basis correctly yields a 20,000 unrealized holding gain. And since it's a trading security, it's reported on net income. Yeah. If converted method. Okay, so we're looking for diluted earnings per share. All right. So net income of 40K. Weighted average common shares outstanding were 100. Also has 500,000 8% convertible bonds convertible into 20,000 shares of common stock. So I guess we need to see if this is dilutive. So 500 times 0.08 is 40,000. So I believe that is dilutive. Let's make sure. 40,000. So 400 minus 40 is 360 divided by 100 minus 20 is 80. 360 divided by 80. 450. So maybe those are anti-dilutive because it made the EPS go up. And because of that, you don't include them in the diluted earnings per share. So I think it would just be 4. I forget if you do something with a tax rate. Let's see. Dang. Okay, I thought I had it right. Oh, you added. I subtracted it. Dang it. All right, let me try this again. I also messed up something anyway. I forgot the tax rate, but let's just want to see. See, I still would have missed it because of the tax rate. So you have to take 500,000 times 8%, which is 40,000. But then you have to subtract the tax rate out, so it's 30,000. So 430,000 divided by the 100 plus the 20,000. So it'd be 430,000 divided by 120,000, which is correct. Under the if converted method, diluted EPS assumes conversion of the bonds at the beginning of the period, which requires adding back the beginning of the period, which requires adding back the after-tax interest expense on the bonds to net income and adding the as converted shares to the denominator. Yeah, so I would have missed it anyway because I forgot the tax rate. But yeah, 430 divided by the 120 equals 3.58. Correctly applying the if converted method. Awesome. Good to know. Under GAAP, the classification of a debt security as trading, available for sale or held to maturity is primarily based on should be that. Yeah, so it's basically whether they want to sell it or hold it, and if they want to sell it, when they want to sell it. Management's intent and ability regarding the security determined at the time of acquisition. Intent to hold to maturity, intent to sell in the near term, or neither of those. Available for sale, the residual category. Debt security classifications based on management's intent and ability regarding the security at the time of acquisition, determining whether it is trading AFS or held to maturity. HTM. Participating. Let's see. I think it's D. Nice. Okay. So participating feature is a share of dividends beyond their stated rate, participating with common shareholders in additional distributions. A participating preferred stock feature entitles preferred shareholders to share in dividend distributions beyond their stated preferred dividend rate, participating alongside common shareholders in additional declared dividends according to the specified participation formula. The participating feature specifically entitles preferred shareholders to share in dividends beyond their stated preferred rate, participating with common shareholders according to the specified formula. Participating with common shareholders according to the specified formula. Cool. Under the FASB conceptual framework, which of the following best distinguishes recognition from measurement in financial reporting? Refers only to the initial disclosure, not in the footnotes. I think A. Nice. Recognition is formally recording an item in the financial statement. Measurement is determining the monetary amount at which it is reported. And that's important because for modified accrual accounting, it's when measurable and available, not when it's recognized for modified accrual. Recognition is the process of formally incorporating an item that meets the definition of an element into the financial statements, while measurement is a separate process of assigning a monetary amount to that recognized item. While measurement is the separate process of assigning a monetary amount to that recognized item. Cool. All right. Under the treasury stock method used to compute diluted EPS for outstanding stock options, how are the assumed proceeds from the hypothetical option exercise used? Not sure. The proceeds are assumed used to repurchase shares at the average market price, reducing the incremental shares added. The treasury stock method assumes options are exercised at the beginning of the period, and the assumed proceeds are used to hypothetically repurchase shares at the average market price, with only the net incremental shares added to the diluted share amount. The treasury stock method uses assumed exercise proceeds to hypothetically buy back shares at the average market price, so only the net incremental shares, not the full option shares, are added to diluted shares outstanding. So only the net incremental shares, not the full option shares, are added to diluted shares outstanding. Good to know. Company purchased a machine for $100. It's been about 10 years, no salvage value. Company revises estimate. The machine's remaining useful life is now estimated at 3 more years, with no change in estimated salvage value. Yeah, okay, that's pretty easy. Book value is $60K, 3 more years, just $20K a year. Yeah, you just change the depreciation expense based off of the book value and the number of years left. So 60,000 and 3 years left, so 20,000 a year of depreciation using straight line. The asset's remaining book value is spread over the revised remaining useful life beginning in the period of the change, with no restatement of prior periods. The $60K remaining book value is spread over the revised 3-year remaining useful life on a prospective basis, yielding $20K of annual depreciation expense starting in year 5. Company enters a contract to sell a product for a base price of $50,000 plus a bonus of up to $30,000. Yeah, so you don't recognize the bonus because it is fully constrained by the risk of revenue reversal. So you do not include the bonus in the transaction price. Variable consideration is included in the transaction price only to the extent it is probable, keyword probable, that a significant reversal of cumulative revenue will not occur. When an entity concludes the bonus is fully constrained due to the significant risk of reversal, none of that variable amount is included in the transaction price. Because the bonus is subject to the variable consideration constraint due to significant reversal risk, only the 50K base price is included in the transaction price at contract inception. Parent company acquires 75% interest at a cost of $450. Subsidiary had identifiable net assets with a fair value of $500. Parent's acquisition date measurement of the non-controlling interest was 150K. So it'd be the 500 plus 150 is 650 times 0.75. 487, 500. Interesting. I see. I'm doing it wrong. Okay. It's the parents' measurement of non-controlling interest is 150 of what they bought. So it was a 450 controlling interest plus the 150 non-controlling interest is 600. And the subsidiary had identifiable net assets with fair value of 500. So you take the difference, and that's the goodwill. So 600 minus 500 is 100. Under ASC 805's entity full goodwill method, goodwill equals consideration transferred plus NCI minus the fair value of all identifiable net assets equals the goodwill recognized. An entity holds a variable interest in another legal entity. Under which party is required to consolidate VIA as its primary beneficiary? Yeah, the party that directs VIE's most significant activities and absorbs its potentially significant losses or benefits. It absorbs its potentially significant losses or benefits. It's one with both the power to direct the VIE's most significant economic activities and an obligation to absorb losses or a right to receive benefits that could potentially be significant to the VIE. So both the power to direct significant activities and an obligation to absorb losses or right to receive benefits that could be significant. Company purchases a patent for 340 with a remaining legal life of 17, but an estimated useful life of 10. I think you take the lower of the two or the greater of the two. I think you take the lower of the two. Yeah, you take the lower of the two, and then obviously you divide them because it's a straight line. A finite life intangible asset is amortized over the shorter, lower of its legal life or estimated useful economic life using straight line amortization absent evidence supporting another pattern. Because the patent's estimated useful economic life is shorter than its remaining legal life, amortization is based on the 10-year useful life consistent with the requirement to use the shorter of the two periods. In a business combination, the acquirer agrees to pay the former owner's initial $50K if it gets a specific revenue target, contingent consideration. Everybody. I guess C. Nice. That's a $30,000 gain recognized in earnings in the current period. Contingent consideration classified as a liability is remeasured to fair value at each reporting date after the acquisition date, with changes in fair value recognized in earnings, not as adjustments to goodwill, which is only adjusted for measurement period changes based on facts existing as the acquisition date. Cool. Company trades in old equipment plus 5,000 cash for similar new equipment. The new equipment is fair value of 32. So it's a gain of 2. Lacks commercial substance. At what amount can we record? The lacks commercial substance part confuses me. Normally I would say a gain of 2,000 is recognized. I think I'm going to say that anyway. Okay, because it lacks commercial substance. If it didn't lack commercial substance, I believe it would be D, but because it lacks commercial substance, the new equipment is recorded at $30K, which is the book value of the old asset plus cash paid. No gain is recognized. When a non-monetary exchange lacks commercial substance and the entity pays cash rather than receiving it, no gain is recognized. And the asset received is recorded at the book value of the asset given up plus the cash paid rather than at fair value. Record the book value of the asset given up plus the cash paid rather than fair value. Yeah, C applies the treatment for exchanges that have commercial substance, which this exchange explicitly does not have. So when commercial substance is lacking and cash is paid rather than received, the new asset is recorded at the $25K book value of the old asset plus $5K cash paid, totaling $30K with no gain recognized. But if it had commercial substance, it would be D, but because it doesn't, it's B. Acquire company pays $700. So it's not goodwill because they paid that and received 750. It's the opposite of bargain purchase gain. So it should be this. $50,000 gain on bargain purchase recognizing net income at the acquisition date. Because that's a gain, whereas goodwill, it's not a loss, but it's not a good thing. A bargain purchase gain is a better deal. Arises when the fair value of identifiable net assets acquired exceeds the consideration transferred, and after reassessing the procedures used to identify and measure the amounts, the acquirer recognizes excess as a gain in net income at the acquisition date. Because what they paid was less than the fair value, therefore they recognize the bargain purchase gain. I said fair value, but yeah, net identifiable assets exceed consideration transfer. The $50,000 excess is recognized as a bargain purchase gain in net income. A travel booking company arranges hotel reservations for customers, collects $1,000 from a customer per hotel stay, remits $880 to the hotel, and retains $120 as its fee. Since it's acting as an agent, the travel booking company should receive. Well, I was going to say zero, but 120, I think. 120, the net fee retained by the company as an agent. Because the travel booking company does not control the hotel room before it's transferred to the customer, it is acting as an agent. An agent recognizes revenue only in the net amount of the fee or commission it retains, not the gross transaction amount. So only in the fee it receives, so 120. Pharmaceutical company incurred the following costs: salaries, purchase of live equipment, solely for a single research project with no alternative use, legal fees. What total amount should be expensed as research and development? I don't think salaries is. I think the equipment probably would be legal fees. Oh, I guess salaries is because that's salaries, research and development. 80K would be legal fees would be 400 and testing the new drug prototype. Probably all of it then. Not positive. Oh, so legal fees aren't? Dang. All research and development costs or expenses incurred, equipment and alternative use expense immediately, while patent legal fees fall outside of research and development and are capitalized as an intangible asset. So patent legal fees. Okay, patent legal fees of $20,000 are capitalized, not research and development. So salaries, equipment, and prototype testing are all R&D, but patent legal fees are capitalized as an intangible, not expense as research and development. Good to know. Patent legal fees. I know the typical legal fees are expense as incurred, but I guess patent legal fees are capitalized as an intangible, not expensed. Okay. Which fund type is used by a state or local government to account for resources it holds in a trustee or agency capacity for others, where those resources cannot be used to support the government's own programs? I think fiduciary. Pretty sure. Awesome. Because they're like pensions and stuff. Fiduciary funds account for resources a government holds on behalf of parties outside the government, like pensions. Yeah. Pension plan participants or other governments, and these resources cannot be used to finance the government's own operations. Fiduciary funds are specifically defined to account for assets held by a government in a trustee or custodial capacity for parties external to the government, matching this description exactly. Held by a government and trustee or custodial capacity for parties external to the government. Cool. During 2024, manufacturing company identified the following performance obligation: delivery of equipment for 250, and training services delivered over a 6-month period, starting immediately for 40,000. The company has completed 1/3 of the training services. So in 2024, they should recognize 250, 1 year of maintenance services, so 30, and training services starting immediately. I think it should be 250 plus 40 plus 30, which is 320. Oh, wait, let's see. Oh, that's in 2025. So yeah, during 2024. So just 30,000 plus 40,000 is 70,000. Oh, I was doing the wrong thing. Okay, training services, my bad. 3 years of maintenance services. Oh, beginning 2025. Okay, I missed that again. And that's in 2025. So for 2024, it should just be yeah, 1/3 train. So 40 divided by 3. Well, I know it's 13.3. Yeah, should be B. Yeah, see, that was all for 2025. That threw me off. So revenue is recognized only when or as a performance obligation is satisfied, measured by progress toward complete satisfaction. So it's just the 40K times 1/3. It's not the rest because that was in 2025. The only revenue earned in 2024 because training is the sole obligation with performance that has begun and progressed during the period. And that's it for the 30 questions. We'll go an hour, so we'll do a little bit more. Let's see this. Everything's good here. So yeah, that's the 30 questions. 80% accuracy, not too bad. But like I said, we'll do 5 more so to get to an hour. In a prior year, a company recognized a 200K impairment loss on a piece of equipment held for use, reducing its carrying amount. In the current year, the equipment's fair value has recovered and now exceeds its post-impairment carrying amount. You can't write the asset up because of conservatism principle in accounting. Yeah, it's going to be D. The recovery is not recognized. U.S. GAAP prohibits reversing an impairment loss on a long-lived asset held for use. U.S. GAAP prohibits the reversal of previously recognized impairment loss on a long-lived asset for use, even if the asset's fair value subsequently recovers. The reduced carrying amount becomes a new cost basis, and depreciation continues based on that new basis because of the conservatism principle of accounting or something. Retailer sells 500K of goods during a promotional period and grants customers a 30-day right of return based on reviews. Estimates that 40K will be returned, which the following correctly describes the country of the sale. I think C. It's either C or D. Let's try C. Nice. Okay. Recognize 460K in revenue, a 40,000 refund liability, and an asset for the right to recover the returned goods. A right of return requires revenue to be constrained to the amount the seller expects to be entitled to. Estimated returns are excluded from revenue and recorded as a refund liability. Yeah, excluded from revenue, recorded as a refund liability. So yeah, the returns are netted against the revenue. So net revenue is basically revenue minus estimated returns with a separate asset for the right to recover returned goods. All righty. Company license a trademark to a franchisee for use in the franchisee's business over a 5-year term. Should this license be treated as providing a right to use or a right to access property, and how is revenue recognized as a result? All right to access, because the trademark's utility changes with the licensor's ongoing activities. Revenue is recognized over time. A license is a right to access intellectual property recognized over time when the intellectual property's utility is expected to change during the license period due to licensor's ongoing activities and the customer is exposed to the effects of those activities. Otherwise, it is a right to use, recognized at a point in time. Because of this, it's a right to access. Over time, as access is provided. Cool. Because the trademark's utility is expected to change over the license term due to the company's ongoing marketing activities, this license meets the right to access criteria, and revenue is recognized over time as access is provided. Vista Corp requires 1,000 shares of its own common stock for $30 per share. It later reissues all 1,000 shares. What account should be as a credit for the 8,000 excess of reissuance price over cost, and by how much? I believe using the cost method for treasury stock, it should be A. Yeah, something you gotta memorize. It's for the cost method of treasury stock. Under the cost method, reissuing treasury stock above its reacquisition cost credits the excess to additional paid-in capital. Treasury stock, or a similarly titled equity account, never has a gain on the income statement. But if it wasn't a cost method, like accrual method, then there could be gains. But for this, it's all to additional paid-in capital. We're going to do additional paid-in capital treasury stock, a component of stockholders' equity. Treasury stock, a component of stockholders' equity. All right, let's do one more. Let's go. Which of the following best describes the expense reporting requirements for not-for-profit organizations? Should be B. Expenses must be reported by both functional and natural classification in the statements, the notes, or a separate statement. Requires not-for-profit organizations to present expenses by both functional and natural classification, with flexibility only in where the presentation appears. Base of statements, notes, or separate statement. All right, and that's a perfect end to it. 35 questions, 83% accuracy, which is pretty good, one of my best so far, and then exactly an hour. So that's it for this study session. Let me know if you have any questions. Please try out my tool, 7-day free trial, no credit card required. I think you'll really like it. It's a great supplemental study material option. And obviously you can also go along with me here, pause the video of the live stream, work it yourself, and then you can see the explanation. I'm going to be adding more questions as time goes on. So I'll have, thousands of questions within a week or so, all relating to the CPA exam. And so, it's a pretty good study tool, and I really think you'll enjoy it. So you should try it out. Let me know if you have any questions. And you join the Discord, subscribe to the YouTube channel, and email me if you need anything else. But thanks again for watching, y'all, and I will see y'all probably tomorrow. I'll see y'all next time for study session for the FAR section number 10. So y'all have a great day.